Let's bring in Steve Wieting. He's the CIO of Group, Chief Investment Strategist. It's great to have you here,
Thank
Steve.
you, Kelly.
Good to see you again. Do you want to just top level address me? Do you favor the rate cut tomorrow?
Well, look, if the Federal Reserve cuts as soon as possible, perhaps they can cut less. It really depends on how the economy evolves. And Steve Leisman's comment about, a lot of the economy is just getting crumbs, sub 1% industrial production growth, 2% drop in construction over the course of the year, 47% growth in IT equipment investment.
Wow.
That is a bifurcated K in the economy. I think they could stop cutting because we're probably going to see those weaker parts of the economy rebound in 2026. Now, it's not going to be massive, but construction and trade can have a better year in the coming year. And that's probably going to be consistent with everybody saying, I see the Fed shouldn't have cut.
Right, and that's fair, but you don't share these concerns about a rapidly deteriorating labor market, or do you share then the optimism that Hassett is saying, which is you could cut not because the labor market's getting worse, but because productivity is a tailwind to the economy and we can have lower rates?
Two things. If you just take a look at job openings, you can take a look at the weekly surveys from Indeed, for example. The labor market is cooling. It's cooling in a way that doesn't look like AI spending.
Really?
And AI is, in every likelihood, is a headwind that is going to continue to slow the labor market. So that would argue again for a little more aggressive monetary policy. But the idea that productivity gains, that the trend rate of growth in the economy is strong, so let's just have zero rates, that's the wrong view too.
Why?
And the 1990s tells us that too, because it does mean, right, that demand for capital in the economy, demand for debt, that the trend pace of economic growth, the interest rate that would stabilize financial conditions, right, to give us, it's very, very hard to do all these things. You say about inflation, employment, but financial stability too. Can you imagine runaway bubbles in the economy with easier monetary policy because the labor market is weakening? This makes it even more difficult for the Fed.
So in the 90s, where was the rate, like 5%, something like that?
You can't really complain about long-term rates in the 1990s. We did a 5.5% Treasury yield. It rose when we had a very strong investment in what was at the time the beginnings of the internet. We should be seeing some of those pressures now, at least modestly so, from all of this. But, the types of debt readings that we're seeing, we see 5 hyperscalers have grown their debt. We're talking about everything from Oracle to Meta, 14%. That's about in line with their revenue growth. That would probably be twice as high, right, if this was just a runaway bubble in debt in terms of those company spending.
I see. So in other words, you're saying if the Fed does what Hassett argues they could do, if they lower rates too much here because we have a highly productive economy, that, they're going to end up stimulating a much worse AI bubble, you think?
That is potentially the case, even if that's what looks right for the labor market. If AI is really making the trend rate of unemployment higher, right, because we're producing more with fewer people, trying to fight that with easy monetary policy can be one of those things that can destabilize the economy too.
On the flip side of that, you are sticking with, as kind of an investment theme or as part of just being in the market, you think the market will continue to do well. You like the tech stocks. You don't seem to share those concerns that Michael Burry and others have had about them being overvalued or frothy or anything like that here.
I think it's just a little soon in this process. Having seen 95, 96, all the warnings, 97, 98, the point here is that we're deep into a bull market. Bull and bear markets are going to exaggerate returns, and there is a price to pay for that. So the median S&P return per year is 15%. The average is 10. The bear markets are going to come, and we have to be prepared for that. But are we at this danger point? Not, again, when the spending on this from profitable companies hasn't reached some critical stage for the economy where we're actually really over the edge.
So you're optimistic for 2026? I
think that we are optimistic for 2026, but I think you have to absolutely prepare. You think about the municipal bond market, 2008, it had a negative 3% return. Treasuries had a 14% return. You think about the healthcare sector. We're expecting a 15 to 20% return in the healthcare sector next year. Maybe that isn't going to quite be as much as some of the AI stocks, possibly, but it's another source of return that is really lowly correlated with what's leading the market right now.